Hello everybody and welcome to the financial planning update for June 2022. We'll begin as we usually do with a brief look at how some of the major global markets have performed during this first half of the year. We say it every year, but once again, how on earth have we arrived in July already? Just for information, I'm filming this video on Wednesday the 6th of July, the morning after the night before, as it were, in a political sense, and we'll come on to the latest events in Westminster a little bit later on. First and foremost though, let's have a look at how the main global markets have fared during this first half of the year. Well, once again, we have this tale of two halves developing. The UK market is the standout top performer, if you like, although even the UK market has now registered a modest decline during this first 6 months of the year. That's in stark contrast, though, to both the US and the global stock markets that have registered much more significant falls, now both down just over 10% year to date. And this is reflective of two things, really. The first of which is the fact that the FTSE 100, the UK market, tends to be home to some of the more conservative style businesses. We have industries like supermarkets, retailers, commodities, banks, insurers that sit within the FTSE 100. And those assets are deemed to be somewhat more conservative perhaps than some of the technology companies that sit within the US market, for example. So that's one of the reasons why the UK market tends to be outperforming during this particular period. And also the UK market is home to many oil, gas and commodity companies, which of course are really perhaps one of the only beneficiaries of this current inflationary environment that we're seeing, because of course that's increased their sales and thus increased their profits quite substantially as well. So that's the reason we see this divergence between the UK market and some of the other major global stock markets. Now, I just want to add an additional feature onto this chart at the moment because we have a very interesting dynamic unfolding. So if we just flick across to this second chart, we can see here I've added the UK gilt market in. So this is UK government bonds. And we see here, quite surprisingly, that government bonds have actually fallen by substantially more during this first 6 months of the year than even the US or the global markets. Government bonds this year down almost 14 and a bit percent. And this is really down to the rising interest rate environment, and also it's due to market expectations of future interest rate increases. Of course, as inflation rises, central banks will often look to increase interest rates to try and stem the tide of inflation. And really that's what causes the negative price movements when it comes to government bonds. So we're in this weird environment really where most asset classes have registered declines during this first half of the year. And there's very few asset classes, in fact, that have registered positive gains. You might look to invest in second-hand cars, for example. That's one of the few asset classes perhaps that's appreciated during these first 6 months of the year. But in general terms, most investment assets have suffered during this rather unique set of economic circumstances. Now, there are some signs, especially when it comes to the bond market, that things might be about to start getting better. So we can look to the yield curve to give us some indication as to what the market expects to happen to interest rates. And this graph is the US yield curve, but you'll see a very similar picture in the UK as well. And this shows the yield or the interest that you will receive if you invest into various maturity terms of US government bonds. And if you turn your attention just to the middle of the chart here, we can see that a 1-year bond would pay you just about 2.9%, just under. But if we move to a 2-year bond, we can see that we'll earn 3.1%. Move further right and we can see that a 10-year bond will pay you only 3.2%. So there's a very small gap between that 2 and the 10-year yield. So there's very little extra reward for investing for a further 8 years in this case. And in fact, this profile has changed slightly. This graph goes up to the end of June, and just in the last couple of days, the curve of that graph has actually strengthened somewhat. So we're now beginning to see what we call an inverted yield curve, where some of the longer maturity bonds actually pay a lower rate of interest than shorter maturity bonds. Now, that might be positive for bond prices, because that does suggest that the market expects interest rates to start to come down in the medium to long term. But an inverted yield curve can also be one of the potential warning signs of economic slowdown. So it could be a mixed bag, but it does show that the market expects at least bond prices perhaps to start to stabilise and potentially increase slightly in the future. Now, in terms of how this translates into portfolio performance, we actually see a rather unique situation where all three of the portfolios are at a fairly similar place. And this is reflective of the bond component of the portfolios having suffered during this first part of the year. And we're also in one of those crossover periods. As the market has recovered, if you look at the March to April window, you'll notice the portfolio's trade positions, and that's very much what we would expect. When markets are falling, you would expect the cautious portfolio to actually be the best performer. That should limit the damage the most. And then as markets recover, if you look at the sort of mid-March to mid-April period, you'll see the adventurous portfolio take the lead once again. And it would appear we're in one of those crossover periods where the market is moving, and so the portfolios are effectively trading places. We've been relatively well positioned during this period, although of course many of the portfolios do have some degree of bond exposure. We have been very, very heavily underweight in government bonds for a very long time now, and even the corporate bonds that we hold tend to be on the shorter dated end of the spectrum, which means that they're slightly less sensitive to interest rate increases. Now, although of course we never want to see these sorts of figures, that they're not particularly out of character given the environment that we're sitting in, and all of the portfolios are still very much within their parameters, if you like. Each of the portfolios has a mandate which we operate to, and none of the portfolios as yet has breached its kind of expected performance parameters. So although yes, we've suffered some declines, these things we plan for, we anticipate that portfolios will go through this process at some point during the investing journey, and we have every confidence that we'll see an equivalent recovery, hopefully at some point not too long from now. Finally, as we usually do, just to compare the performance of the active and the passive portfolio variance, as we can see here, even some of the best active managers have not been able to protect us from the falls that we've seen in markets during 2022, and we see that the passive portfolio actually eking out a somewhat larger than usual outperformance during this rather turbulent time. So with all of this going on, of course, we start to look for some good news. Where are the glimmers of hope? Where's the light at the end of the tunnel? And I think it's fair to say just in these last couple of weeks, we might have started to see some signs of turnaround. Now, this is the copper price index. So we're looking here at the price of copper. And we can see here that during the period between 2017 and early 2020, the price of copper was relatively stable. Since 2020, since the start of the pandemic, demand for copper has been significantly rising, and really that's continued all the way through just until these last couple of weeks. Now, if you notice on the right-hand side of the chart, you'll see a very, very steep decline just in the last couple of days in the price of copper. And we've seen a very similar story unfolding across many of the global commodity markets. Now, this is in response to market fears of an economic slowdown, which tends to then reduce demand for commodity prices. So although this may not be universally good news, what it might be showing is some signs that we could see the current sort of inflation spiral starting to slow down. If demand starts cooling off for some of these core commodity products, we might then see that feed through, hopefully, into lower inflation numbers in a few months' time. And that's just a sign that something is changing, the sentiment is shifting perhaps. And that might just be a glimmer of hope, especially when it comes to the inflation story. And really, when it comes to our hot topics, of course, inflation is still one of those. Inflation is one of those indicators where you can almost see it coming, really, because as we were just discussing, you can look at the prices of commodities and input costs, if you like, into manufacturing foods and goods and services. And it often takes a number of months before that feeds through into the prices which we see at the supermarket tills. And indeed, there's been an industry body that suggested that food inflation might be set to continue for another 6 or 12 months, because that's how long it takes for these input costs to feed through the supply chain. But we are seeing, as I've said, some commodity price softening, which for inflation in the medium term should hopefully start to provide some light relief. It's also pleasing to see that China is starting to reopen. Lockdowns there appear to be easing. The COVID situation seems to be easing off somewhat. So that is encouraging, and hopefully that should start to unclog supply chains, which again could be very positive for the inflation numbers. And then finally, just yesterday evening, we had another potential spanner thrown in the works. Of course, last night we saw both the Chancellor and the Health Secretary resign, which is rather unprecedented, really. So yet another one of these unprecedented events. And of course, Boris's position now looks rather uncertain, although this morning, I'm speaking on the 6th of July, at the time of presenting this session, it would appear anyway that Boris is set to try and hold on. He appears resolute in his stance that he wants to be Prime Minister and he wants to fight the next election. How tenable that position will be in the coming days, it remains to be seen. But suffice to say, this has added just another element of uncertainty. And of course, it raises the prospect of a UK election. Now, the early indications are actually that the market would view that as a bit of a relief, really. We all know that the market loves nothing less than uncertainty. And frankly, Boris is causing plenty of that in his current position. So I think actually there are some signs that the UK market might be somewhat pleased if we went through an election cycle, because it would then potentially create a more stable political platform for the UK moving forward. And finally for today, we often consider some advanced financial planning ideas. Now in fact, these ideas are not particularly advanced at all. We really are going back to basics here and just reminding clients of some of the key things that we can do during some of these more testing economic times. And I'm focusing here on inflation busting ideas, really. What can we do to minimise the impact of inflation? How can we protect our portfolios as much as possible? So some of these are the real basics, the bread and butter sort of financial planning actions. But it's important even during these times to make sure that we're maximising, for example, our pensions, our ISAs, our VCT contributions where appropriate. Of course, many of these things provide upfront tax relief. In a pension, for example, we're going to receive at least a 20% tax relief uplift on the contribution that we make. And of course, that gives us a 20% head start when it comes to our portfolio value. A VCT contribution, venture capital trust contribution, that provides a 30% income tax relief, for example. So these things just give us a real boost, a real bonus, which of course goes some way to protecting against inflation. It's important also to remember some of the usual investing lessons. You know, if we have a falling market, it can be useful to do what we call averaging in, or pound cost averaging. You know, invest, if you have a lump sum, invest that little and often. And that means you're minimising the risk of any short-term market volatility. It's definitely wise to continue regular savings programs if you can. If we've got any regular contributions being paid into ISAs or pensions, for example, it's a really good idea to continue those regular savings contributions. Because of course we're buying units now at a lower price. You know, the market is on sale effectively, so it can represent a more attractive time to invest. And of course it makes sense, and this is one of those sort of blindingly obvious things, but it's amazing some of the costs that we have on our bank accounts that we don't really need. Just have a look through, are there subscriptions that could be cancelled? Are there things that could be renegotiated? Are there insurances where we could find savings, for example? So all of these sort of usual lessons, but they become increasingly important during a time like this. So that's everything we have for today's financial planning update. I hope that provides some sense of reassurance, and that there are now starting to be some glimmers of hope out there, I think, when it comes to the inflation story, at least. Of course, we'll keep a very close eye on the political environment and provide any further updates where appropriate. That's it for today. Thank you for watching the video. As always, if you have any concerns about your own financial planning, please don't hesitate to contact a member of the Buckingham Gate team.